Hey, what's going on, guys? It's Ethan here, and today we're going to talk about the differences between a 15-year mortgage and a 30-year mortgage and which I think would be best for you.
Darling, just hold on. Darling, just hold on.
So I know many financial advisors are really divided on this subject. Some think the 30-year mortgage is a better option, but some think the 15-year mortgage is a better option because on the surface it does look like you're paying a ton more in interest, which you are, but as we look deeper, you're going to figure out why I think you should use the 30-year mortgage. So I think this subject is very important to you just because maybe when you're going to buy a home someday, knowing at least the differences between a 15-year mortgage and a 30-year mortgage, how much you're going to pay based on the month, what the interest looks like, could make a really big difference in your decision making for what you decide in the future. So now let's just go into the pros and cons of each. So first, for the 15-year pros, it has a lower interest rate first off, and the reason for this is because the loan period is shorter, there's less risk for the bank. So the bank often pays about 0.25% to a percent lower in the interest rate compared to a 30-year mortgage. The second one, simply since we know it's a 15-year mortgage, you'll pay it off sooner than the 30-year mortgage. And this will give you the ability to spend that money elsewhere once the money's paid off. And the last, because you're paying it off quicker, you're building more equity in the home. Okay, so now onto the 15-year cons. First, you're going to have a higher monthly payment. As you understand, because you're paying it off sooner, you're going to have a higher monthly payment every single month compared to the 30-year mortgage. So because your payment is also so much higher, you're going to get approved for less real estate. You're not going to be able to buy as big of a home, and the reason for this is your monthly payment can only be so high. And if you could buy a huge house on a 15-year mortgage, you might not have the income, or the bank might not trust you enough with the income that you have to be able to have a payment that large. Okay, so now into the 30-year pros. Of course, one of the pros is it's a lower monthly payment. This offers a lot more cash flow for you to do with what you want with your money, whether that's spending it on other things or whether that's investing that extra money that you have each month. And the second thing is you do get approved for more real estate. So if you're wanting to buy a bigger house and you know you can pay it off, sometimes it's nice to be able to have that 30-year mortgage with a lower payment so you'll be able to be approved for more real estate than the 15-year mortgage. And then the 30-year con. So you're going to have a higher interest rate. That's because the bank's going to see more risk because the loan's over a longer period of time. And second, it's longer to pay off than the 15-year mortgage. You're going to be paying off this mortgage for 30 years instead of 15 because you have these lower payments and longer period. And the last thing, because it's a 30-year mortgage, it's going to be slower to build equity. You're going to be paying a lot more interest in the beginning than you would a 15-year mortgage because the loan is over a longer period of time. So I know I'm talking about how the interest rates are a little bit higher on a 30-year and a 15-year and that you're going to have to pay more interest on a 30-year than the 15-year, but I want to get into some examples to really show you how much more that is. So at the current moment, let's say you're buying a $250 house, you have a 20% down payment, which is a $50,000 down payment, so your loan is worth $200,000. So for the effective interest rate for these loans at the current moment, the 15-year would have an interest rate of 3.41%, and the interest rate for the 30-year mortgage would be 4.06%. So the interest that you pay over the lifetime of the loan, you would pay $55,769.57 in interest on the 15-year mortgage. Next, on the 30-year mortgage, you'll pay $146,234.20. So then let's go into the monthly payments. The 15-year mortgage monthly payment, you're going to be paying $1,420.94 every single month for the 15 years. And the 30-year, because it's over a longer period of time, your monthly payment's only going to be $961.76. So yes, from the surface, it does seem like you're paying a whole lot more interest on the 30-year mortgage rather than the 15-year mortgage, which is true, but as we dig deeper, you're going to fully understand why I still think you should be getting the 30-year mortgage. So the first reason, I'm just going to talk about how inflation can play a big role in you getting the 30-year mortgage. Because the money's value that you have will be decreasing over time, but the monthly payment isn't increasing. It's staying the exact same for the whole 30 years, even though inflation is still playing a role. So to give you the actual numbers, assuming a 2% inflation rate of what our actual mortgage payment interest rate would be, for the 15-year mortgage it'd be 1.41%, and then for the 30-year mortgage it would only be 2.06%. And when realizing this, it really shows you what you can do with that money by investing it otherwise. So now, where am I going with all this? Let me give you another example. So now with the 15-year mortgage, let's say you bought a $250,000 home with a 20% down payment. So that gives you the loan that's $200,000 with the interest rate that we stated before of 3.41% for that 15-year mortgage. Now, the 30-year mortgage, on the other hand, has a 4.06% interest rate, as we stated before, and you'll be buying at the same house, $250,000, 20% down payment, so your loan will be worth $200,000. So now here's the plan for both examples. First, with the 15-year mortgage, you're going to be paying $1,420 every single month and for the 15 years until the house is paid off. And then you will invest that $1,420 until 30 years is up. Now with the 30-year mortgage, you're going to kind of do the opposite. You're going to spend that $961 on the mortgage payment every month, but then you're going to invest $459 every single month, which is basically the $1,420 minus the $961. So really you're using all of the $1,420 every single month, but you're putting part of it into your payment for your house and you're putting the other part of it into investments. And you'll be doing this for the whole 30 years because the mortgage lasts 30 years, unlike the 15-year mortgage, where you'll only be doing it for 15 years and then investing the other 15 years. Okay, so let's look how they're doing after 15 years. First, for the 15-year mortgage, they're going to have their whole house paid off, which that means they'll have $250,000 in equity in the home. However, they haven't begun investing yet, so their investments total is $0. On the other hand, the 30-year mortgage, they will only have $123,000 paid off in the house. So they don't have that full $250,000 like the 15-year mortgage person does. But on top of this, they do have investments worth $143,000 if you count a 7% post-inflation rate, which is what we'll be using for this whole video. Okay, so after 15 years, the 30-year mortgage example, they would have a net worth of $266,698.74. On the other hand, the 15-year mortgage person would only have a net worth of $250,000. So now let's see what happens after 30 years. So first, after 30 years with the 15-year mortgage, you would have $694,579, both with the equity in your home and your investments total. On the other hand, with the 30-year mortgage, you would have a net worth of $789,843, counting the $250,000 of equity in your home and the other total of your investments. So from this example, after 30 years, the 30-year mortgage came out ahead of the 15-year mortgage by nearly $100,000. Now the reason for this is because with the 30-year mortgage, the person started investing right away. And because of this, they were allowed to use compound interest to their advantage, so their money started growing in an exponential form. Unlike the person that was using the 15-year mortgage, they weren't able to start investing for 15 years because their monthly payment was so much higher. So yes, from a purely mathematical standpoint, if investing and assuming a 7% post-inflation return in the stock market, which is what the stock market has returned on a consistent basis over the past 40, 50 years, even the history of the stock market, yes, there are chances that your investment might fall. But if you do not take the money out of your investment and leave it over the full 30 years, your money will regain and you'll have close to a 7% return by the end of the loan. So yes, right now I would recommend investing in a 30-year mortgage rather than using a 15-year mortgage because of the interest rates that are super low right now, and you would have the ability to be investing the whole term. But there are some reasons that I understand why certain people would not be wanting to get a 30-year mortgage. So let me explain them now. First, if you don't have the discipline to invest the extra money for the 30-year mortgage. Yes, I completely understand for some people that don't have the discipline to invest, sometimes it's better for them to get a 15-year mortgage because the mortgage for them is almost a forced savings plan because they have to pay it. But the investments that I'm saying you should do in the 30-year mortgage, some people don't have the discipline to do that. And if you don't, that's one case I do recommend getting a 15-year mortgage. And here's the reason for this. If you don't have the discipline to actually invest that money, the 15-year mortgage will come out on top. So for the 30-year mortgage to be better, you actually have to make the investment. So for anyone that doesn't have the discipline, I do not recommend them using the 30-year mortgage. I recommend them using the 15-year mortgage as more of a forced savings plan. So second, if interest rates are really high, let's say interest rates go up to 7%, it's going to be a lot harder to make that discrepancy from the interest payment on your loan to the investments if interest rates are so high. So this might be another reason that I do recommend getting the 15-year mortgage, because it would be a little more risky because of how high interest rates are at the moment. However, at the very current moment, interest rates are actually very low. So I would recommend getting the 30-year mortgage right now. And overall, that's just one thing you have to look at. You can just look up what are the interest rates right now and see the percentage. If it's below 4.5% or even 5%, I do recommend getting the 30-year mortgage, but sometimes interest rates can go up to 7, 8, 9%. And for that reason, you might want to stick with the 15-year loan. And third, there's a lot of people that I know just have more peace knowing they're debt-free. So a lot of people that follow Dave Ramsey, for example, after they're done, they feel at so much peace by having this debt paid off, and I fully understand that. But from a mathematical standpoint, we can understand that the 30-year mortgage is better if you're going to invest that money. But there's a lot of people that are really risk adverse, and they really just want to get that house paid off so they can have that sense and that feeling of peace. I fully understand, and I do think that that's what would be best for them with going with the 15-year mortgage. Thank you so much for watching this video. Please like, comment, subscribe, and turn on your post notifications so you can see when we post another amazing video. So guys, again, thank you so much for watching this video. I really hope it helped for you to see the difference between the 15-year and the 30-year mortgage and why I think the 30-year mortgage is better for most people. And again, if you have any questions for me, feel free to DM me on Instagram at MakingSenseOfFinance, or just leave a comment down below and I'll make sure to answer them.